Hello everyone, John AG here. Welcome back to my channel Aurex. If you haven't yet, subscribe to my channel. In this channel, you will find the real information, real market updates that everyone cannot tell you. So please subscribe to this channel, and I love all of my subscribers for your support. And please watch this video till the very end because YouTube will not push my videos to more people unless you engage. And what we are going to cover today is too critical to be buried by an algorithm. There is a ghost operating inside the global financial machine right now. It is a phantom that Wall Street utterly refuses to acknowledge, a glaring, flashing mathematical impossibility that central banks are praying you never, ever notice. Over the last several years, something entirely unprecedented in modern economic history has happened in the physical silver market. As of today, May 21st, 2026, we are staring down the barrel of a market that is fundamentally, structurally, and irreparably broken. Mountains of physical silver, hundreds of millions of ounces of tangible, irreplaceable metal have been systematically drained from the London Bullion Market Association, the LBMA, and the COMEX vaults in New York. If you strip away the mainstream media noise and look exclusively at the raw, unfiltered data, the sheer physical reality of above-ground, available stockpiles reveals a terrifying truth. Roughly 60% of the institutional free-float silver has quietly vanished into the ether. Let that sink in. 60%. Gone. And yet, despite an ongoing brutal structural deficit that is now stretched into its sixth consecutive year, despite an acute liquidity squeeze that briefly drove prices to a staggering all-time high of $121.67 in January of this year, the spot price of silver has plummeted. It has been violently, artificially forced back down into the $75 to $80 range in recent weeks. Ask yourself this question: how does this happen? How does a critical global asset, an element forged in supernovas that is absolutely essential for everything from artificial intelligence infrastructure to advanced military hardware, evaporate from the global vaults while its price is beaten into the ground? If 60% of the world's oil reserves suddenly disappeared, what would happen to the price of a gallon of gas? It would explode overnight. If 60% of the world's wheat was wiped out, bread would become a luxury item. But silver? Silver is suppressed. Today, we are going to tear down the facade. We are going to look at the World Silver Survey 2026, the shocking collapse in mining ore grades, the silent, aggressive hoarding by sovereign nations, and the absolute, undeniable manipulation of the paper derivative markets. This is not just a story about finance. This is a story about human labor, the absolute limits of our planet's geology, and a global financial system that is currently running on the fumes of an illusion. To understand the sheer magnitude of the deception being played on you, you first have to understand what physical silver actually is, and more importantly, what it is not. Silver is not a digital token. It is not an abstract concept printed on a piece of paper by the Federal Reserve. It is a rare, tangible, highly conductive element extracted from the earth through immense human effort, sweat, blood, and diesel fuel. For decades, the global supply of this critical metal was managed through a network of opaque, heavily guarded vaults, primarily situated in London and New York. These vaults acted as the world's buffer. They were the shock absorbers for global industry. If a massive tech company needed raw materials, the vaults provided the liquidity. But in late 2025, those shock absorbers completely blew out. According to the World Silver Survey 2026, which was recently released in mid-April, the silver market experienced an unprecedented liquidity squeeze last October. The physical silver genuinely available for day-to-day over-the-counter operations in London, what industry insiders refer to as the free float, plummeted to a record low of approximately 136 million ounces. To put that number in perspective, you have to look at the trading volume. Daily trading turnover in the London market averaged about 450 million ounces a day. Read that again. The market was trading paper contracts representing 3 times more silver in a single day than actually existed in the vault. They were trading shadows. When this reality began to leak into the broader market, lease rates, which is the cost of borrowing physical silver, spiked to an astonishing 39%. Usually, in a healthy, functioning market, that rate sits comfortably below 1%. Wall Street and London brokers woke up in cold sweats, realizing the metal simply wasn't there. It had been drained by forces they could no longer control. What followed was the historic January 2026 price explosion. As the short sellers panicked, scrambling to find physical metal to cover their highly leveraged bets, the price of silver momentarily broke free from its paper chains. It soared past $100, briefly touching $121.67 per ounce. For a fleeting, glorious moment, the curtain was pulled back, and the world saw the true, unsuppressed value of physical silver in a depleted market. But the cartel of institutional paper traders could not allow that reality to stand. A true price discovery in silver would act as a glaring spotlight on the devaluation of fiat currencies worldwide. Through an avalanche of unbacked derivative contracts, they unleashed a tidal wave of paper silver onto the COMEX, artificially crushing the price back down. Think about the sheer absurdity of this mechanism. In the highly financialized modern economy, the price of the commodity has been entirely detached from the physical good itself. When the vaults run empty, the massive bullion banks do not panic about a lack of supply. They simply hit the sell button on billions of dollars worth of synthetic paper silver. They overwhelm the physical reality with digital fiction. They create a holographic supply of metal to terrify speculators into selling their positions, driving the price down to levels that defy the laws of supply and demand. Their faces are covered in dust and grime, operating heavy machinery in dark, cramped, sweltering conditions. The sound of jackhammers and rock crushers fills the audio track. But paper contracts do not build civilization. We must look at the human and geological reality of where silver actually comes from. You cannot print silver. You cannot conjure it out of thin air via a central bank quantitative easing program. It must be dragged out of the earth. And right now, the earth is exhausted. In the first quarter of 2026, the production reports from the world's major silver producers came across the wire, and they painted a dire, almost apocalyptic picture for future supply. The problem isn't that miners are lazy. The problem isn't a lack of equipment. The problem is the earth itself. The ore is dying. Major miners like Endeavor Silver and Pan American Silver reported their production in core legacy mines dropping by a staggering 22% year over year. Why? Because of an 18% to 20% decline in silver ore grades. If you don't know what ore degradation means, let me make it very simple. 20 years ago, a miner could dig up a ton of rock and extract 15 to 20 ounces of silver from it. Today, that exact same ton of rock, requiring the exact same amount of dynamite, the exact same amount of human labor, the exact same amount of heavy machinery, and significantly more expensive diesel fuel, yields barely 4 to 6 ounces of silver. They are digging up the same amount of dirt, processing the same amount of rock, expending vastly more capital, but getting fractions of the metal out of it. The rich, easy-to-reach veins of silver that built the modern world have been tapped out. We are scraping the bottom of the barrel. We have hit peak silver, and we are currently on the downward slope of global geological depletion. When the price of silver was artificially forced down from $121 back to $75 over the last few months, triggered by completely manipulated narratives around producer price index data and shifting Federal Reserve interest rate expectations, the mining companies were backed into an impossible corner. Basic economics dictates that lower prices should curtail supply, and that is exactly what is happening, but it is happening in a way that creates a systemic, unbreakable death spiral. When prices drop to $75, marginal mining operations deep in South America and Mexico suddenly become unprofitable. The cost to extract the metal exceeds the price they get paid for it. Companies like First Majestic have openly stated they are forced to process lower-grade rock just to keep the lights on, while intentionally leaving the better ore in the ground for when prices finally reflect reality. The industry-wide picture for 2026 projects a 2% contraction in total silver mine supply. So, I want you to synthesize these two facts in your mind. We have a market where above-ground inventories have been largely wiped out by 60%, and simultaneously, the underground reserves are yielding vastly inferior ore at a much higher cost of extraction. The physical supply chain is bleeding out, and there is no tourniquet in sight. While the supply is violently contracting, demand is transformed into a relentless, invisible devourer. For 6 consecutive years, dating all the way back to 2021, the global silver market has operated in a massive structural deficit. The cumulative shortfall over these 6 years is approaching 800 million ounces. Let me repeat that so you understand the gravity. 800 million ounces. That is nearly an entire year of global mine production completely erased, devoured, and digested by industry, never to return to the above-ground stockpiles. Where is it all going? Why is this deficit entirely unfixable? Because silver is a schizophrenic metal. It possesses a dual identity that no other element on the periodic table can match. It is simultaneously the ultimate monetary safe haven against inflation and the absolute ultimate industrial necessity for the future of human technology. And in 2026, the industrial demands placed on silver are unlike anything in human history. Let's break down the pillars of this demand. The artificial intelligence revolution. The massive, sprawling data centers powering the AI models of the future do not run on thin air. They do not run on digital promises. They run on advanced semiconductors, sophisticated thermal interface materials, and highly complex heat dissipation systems. Silver is the most thermally and electrically conductive metal on Earth. There is no substitute. According to recent tech reports, AI server clusters require 2 to 3 times the silver content of traditional legacy data centers. As the tech giants of Silicon Valley spend hundreds of billions of dollars aggressively building out their AI infrastructure in 2026, they are quietly, relentlessly vacuuming up whatever physical silver they can find. The green energy transition. Despite rising raw material costs and inflation, the photovoltaic, or solar panel, industry continues to consume massive, jaw-dropping amounts of silver. Even as manufacturers desperately attempt to thrift or engineer their panels to use less silver per unit, the sheer, staggering volume of global solar deployment completely overwhelms these microscopic savings. The push for green energy across Europe, China, and North America requires hundreds of millions of ounces of silver paste every single year. The military-industrial complex. This is perhaps the most closely guarded secret in the commodities market. Modern warfare is electronic warfare. Advanced missile guidance systems, radar arrays, autonomous drones, nuclear submarines, and low Earth orbit satellites require vast amounts of silver for their conductivity and reliability in extreme, high-stress conditions. When a Tomahawk missile detonates, the silver inside it is not recovered. It is vaporized. It is gone forever. As geopolitical tensions boil over, with the world on an active war footing in early 2026, global defense contractors are hoarding industrial metals. They are buying physical silver, and they do not care what the price is. And then we have the sovereign nations. This is where the geopolitical tectonic plates are shifting beneath our feet. Look at the COMEX delivery numbers from earlier this year. In just a 60-day window in early 2026, the sovereign nation of Turkey imported over 20.3 million ounces of physical silver. That is not a rounding error. That amount represents roughly 26% of the entire COMEX registered inventory, absorbed by one single country in 2 months. Why did they do this? Because Turkey, alongside India, China, and the expanded BRICS Plus nations, saw the writing on the wall. They saw inflation ravaging Western fiat currencies. They saw the weaponization of the US dollar, and they moved aggressively, relentlessly, into physical, tangible assets. They are draining the Western vaults, taking delivery, and putting that metal on airplanes to fly it back to the East. They are not playing the paper game, they are playing for keeps. So you have the titans of AI, the global solar industry, the vast military-industrial complex, and sovereign Eastern nations all aggressively, simultaneously, stripping the physical silver market bare, representing true physical supply. On the other side, an absolute skyscraper of paper contracts, hundreds of times larger, falls over and crushes the silver bars under their weight. The sound of tearing paper and heavy impacts. This brings us to the ultimate question, the real reason you clicked on this video today. If the vaults are 60% empty, if the ore is degrading, if the deficits have raged for 6 long years, and if technological and geopolitical demand is exploding, why in the world did the price of silver drop back to $75? The answer lies in the greatest financial illusion ever perpetrated on the modern investor, the fractional reserve paper derivative market. You see, the price of silver that you see flashing on your television screen or the ticker you see on your smartphone trading app is not determined by a farmer buying physical silver for his solar panels. It is not determined by a semiconductor company buying physical silver for their AI servers. The price is dictated, manipulated, and controlled in the futures markets of the COMEX in New York and the LBMA in London. These markets trade paper contracts that merely represent silver. For every 1 ounce of actual physical silver sitting quietly in a vault, there are upwards of 250 to 300 ounces of paper silver traded digitally on the screens. This grotesque hypothecation allows massive financial institutions, bullion banks, and algorithmic hedge funds to completely hijack the price discovery mechanism. When the physical squeeze pushed silver over $120 in January, it threatened to literally break the global financial system. The bullion banks were caught massively, painfully short, meaning they had bet billions of dollars that the price of silver would go down. If they had been forced to actually deliver the physical silver they had promised to their clients, they would have faced catastrophic, multi-billion-dollar losses. It would have triggered a cascade of bankruptcies that would have made the 2008 financial crisis look like a minor speed bump. So what did they do to save themselves? They utilized their infinite, unchecked access to fiat currency and credit to dump an overwhelming, biblical volume of naked short contracts onto the market. They sold silver that literally does not exist. They hammered the bid. They created an artificial digital tsunami of supply to terrify retail investors and speculators into liquidating their positions. And then they used macroeconomic data as their cover story to hide the crime. In mid-May, when the U.S. Producer Price Index data came in hot, suggesting that inflation was sticky and the Federal Reserve would not cut interest rates this year, the algorithmic trading bots went into a frenzy. The mainstream financial media immediately spun the narrative. Higher interest rates mean silver is less attractive. Massive institutions like UBS and JP Morgan released perfectly timed, highly publicized reports forecasting a narrowing of the silver deficit, cutting their investment demand estimates, and projecting sideways prices. The algorithms read these headlines, processed the sentiment in milliseconds, and hit the sell button thousands of times a second. But I want you to look past the screens. Look at the physical reality. Did a hot inflation report somehow put 100 million ounces of silver back into the ground in Mexico? No. Did a Wall Street analyst report magically replace the 20 million ounces that Turkey took home? Absolutely not. The physical reality remained completely unchanged. The COMEX warehouse reports filed just 2 days ago showed registered silver, the metal actually available for delivery, at around 80.9 million ounces. That is essentially unchanged, mathematically perilous, and critically low. The paper market operates on sentiment, algorithms, leverage, and deceit. But the physical market? The physical market operates on mass, energy, thermodynamics, and reality. Right now, the paper market is dictating the price, but it is a coiled spring, and the further they push the paper price down below the fundamental cost of physical production, the tighter, the more explosive that spring becomes. Dust motes float in the air where massive pallets of silver used to sit just a few years ago. The scene transitions back to John A.G. in the studio. He leans forward, looking intensely and directly at the viewer. We cannot talk about these millions of ounces and billions of dollars without talking about what this actually means for human beings. Because at the end of the day, economics is about human survival. For the average citizen, this price suppression of precious metals is a massive, hidden tax on your life. Silver, alongside gold, has been the ultimate barometer of a failing currency for over 5,000 years. By artificially suppressing the price of these metals, central planners and central banks create a false, dangerous sense of security. They make it look like fiat currencies, the dollar, the euro, the yen, are much stronger than they actually are. It prevents the financial alarm bell from ringing while the house is actively burning down around us. Meanwhile, the middle and working classes see their purchasing power absolutely destroyed. You go to the grocery store today in May 2026, and you see the horrifying daily reality of cumulative inflation. The cost of food, housing, electricity, and insurance has skyrocketed. You feel poorer because you are poorer. But the financial elites sit on television and tell you everything is fine, pointing to a manipulated stock market and artificially suppressed commodity prices as proof of their economic genius. But listen to me very carefully. There is a reckoning coming. The immense, agonizing divide between the paper illusion of Wall Street and the physical reality of planet Earth is reaching its absolute breaking point. You cannot run a deficit of 800 million ounces over 6 years and expect the music to keep playing forever. You cannot have sovereign Eastern nations draining massive quantities of physical metal while the vaults are already at record historical lows. The physical buffer is gone, the free float is exhausted, the illusion is running out of time. What we saw in October 2025 and January 2026 was just a tremor before the devastating earthquake. The shorts were forced to cover and paid unprecedented lease rates for near-term liquidity just to survive the week. But when the next exogenous shock hits, and it will hit, whether it is a further escalation in global kinetic conflict, a sudden breakdown in the U.S. Treasury bond market, or the stark realization by the tech monopolies that the AI infrastructure build-out physically cannot source the metal it needs, the paper derivative market will suffer a catastrophic, systemic failure of delivery. When the industrial buyers and the sovereign nations stand at the COMEX delivery window and finally say, "We don't want your cash settlement, we don't want your rolled-over paper contracts, give us the physical metal we paid for," the game will end instantly. And on that day, the price of silver will not be determined by an algorithm running in a server farm in Manhattan. It will not be determined by a manipulated futures contract. It will be determined by the desperate, frantic, unlimited bidding of industries and nations that literally cannot survive without it. We are living in an era of profound, historic financial deception. The 60% disappearance of institutional silver inventories is not a fringe conspiracy theory. It is a documented, verifiable mathematical fact backed by the World Silver Survey, the LBMA data, and the COMEX Vault reports. The powers that be have desperately managed to push the price back down to the 70s to maintain the illusion of control for just a little while longer. But illusions cannot build solar panels. Illusions cannot guide supersonic missiles. Illusions cannot store generational wealth through the inevitable collapse of a debt-based fiat currency system. The physical reality is violently asserting itself. The ore grades are falling. The miners are struggling to survive. The vaults are echoing with empty space, and the demand is completely, totally inelastic. This is the ultimate asymmetry in the financial markets today. The downside is heavily protected by the brutal reality of production costs and geological scarcity. The upside is limited only by the mathematical infinity of fiat currency printing. You are watching financial history unfold in real time. The paper facade is burning away, and beneath it, the enduring, unyielding reality of physical wealth is waiting to reclaim its true value. Thank you for watching this deep dive. If this information resonated with you, if you see the cracks in the system that the mainstream financial media completely refuses to acknowledge, please like this video, share it with someone who needs to hear the truth, and subscribe to Aurex. Remember, they don't want this information out there, and YouTube's algorithm absolutely won't promote it without your direct help. Stay vigilant, stay informed, and protect yourselves and your families out there. I will see you in the next video.